Ladies and gentlemen, I hope you have enjoyed the coffee break. I did very much so, because I also had the opportunity to say hello to a few new members, which of course had the drawback that I couldn't talk to some of our long-standing members. But let me take this opportunity to mention that SUERF lives from membership. It's like Wikipedia or a lot of other things today. And Dragana, my colleague in the background, is very happy to collect business cards of people who think a personal or a corporate membership would be a good option. I recently suggested a corporate membership to a banker, and of course at one point he asked, well, how much is it? And he was shocked to learn how cheap it was. So if you like today's conference, it would be a nice opportunity to get into contact with Dragana. C'est mon plaisir maintenant d'inviter le président de la Banque de France, le gouverneur de la Banque de France. Je pense que le titre citoyen n'est pas applicable dans ce cas. Le gouverneur de la Banque de France, Monsieur Villeroy, who will speak about economic adjustments in Europe, the case of France. And SUERF, after all, is, as you reminded me, a French acronym, Société Universitaire Européenne de Recherche Financière. So that's the 5 words I have learned to pronounce in correct French. It's a big pleasure to have a representative of that country.
Thank you very much. Good morning, guten Morgen, bonjour. Ladies and gentlemen, I'm very pleased to be here in Frankfurt am Main. Thanks to the regular meetings of the ECB's Governing Council, this German city is now almost as familiar to me as Saarland, where my family roots are. Ich möchte der Deutschen Bundesbank und meinem Freund Präsidenten Jens Weidmann herzlich danken. Ich muss sagen, Jens, ich wurde von diesem Gebäude, ich verstehe, das sind nur Regional Headquarters von Hessen, wirklich sehr beeindruckt. But I would like also to thank SUERF and the European Money and Finance Forum. As you said, Mr. Chairman, you are a perfectly European society with a French acronym and an English name, and with a chairman who speaks German, French, English, and probably other European languages. I also want to thank the GIC, Global Interdependence Center, all of them for having invited me to speak at this high-level conference. The theme of my speech this morning was given to me without any choice and in a very precise manner, as you see, economic adjustments in Europe, the case of France. And I started thinking about this theme and why it had been given to me. The first part of the answer is quite obvious: economic adjustments in Europe. Let us have a look at some interesting economic indicators. They all highlight the need for action in the euro area, despite the present robust expansion we have. First, there are still strong balance of payment disequilibria. They have been partly corrected in the aftermath of the crisis, but sometimes at the expense of domestic demand in crisis-stricken countries. Then there are, as you see, GDP per capita and unemployment. What we see here is that so far, and especially since the crisis, the euro area has not enough delivered real convergence. You see then on each of these indicators the relative position of France. So, how can we foster this economic adjustment. Monetary policy fully plays its roles, but it cannot and should not be the only answer, the only game in town, all the more so as its impact on euro area disequilibria may be limited. But I will not speak over monetary policy today. I am more on the economic side. Let me now come to the second part of my suggested theme, the case of France. And here, I thought about it. The answer is probably less obvious. Why this theme? A lazy answer could be that you ask me to speak about the country I know best, but this would be a bit short. There are probably three deeper possible explanations. First, there is, since Mr. Macron's election, something like a French momentum, and I will comment a bit about that. Second, there is still a French economic challenge, which is, and this is the interesting part, probably tantamount to the one of the Eurozone as a whole. And third, and I will come to them, the program of French reforms, as they are ongoing and as they are strengthened, is probably an interesting example. A French momentum, question mark. There are indeed strong French assets, and the momentum is perhaps simply that people within and outside France rediscover them. Let me say some words first on capital. Business investment is the highest and among large euro area countries. The colors are always the same. France is in blue, Germany in red, Italy in green. What did I say? What did I make wrong? You see it on the right. And euro area as a whole is in dark. So business investment was rather resilient through the crisis. Same for public investment, which is one of the highest in the euro area, and the quality of public infrastructure is a consequence of that. Probably less well known about technology and what is sometimes called French tech. This is an analysis by Deloitte about the so-called Fast 500 winners, and you see that French share is over proportional. Let me now come to some assets on labor. Labor productivity, it's as high as in Germany, close to the US productivity, and higher than in the euro area. This is hourly productivity. More significant is probably the evolution of demography, and this is a relative, I stress a relative French asset in the euro area with a positive demography till 2013, including a projected effect by Eurostat of migrations. Last element about this French momentum and against question mark, and this is probably where the Macron's effect is the most significant, it's the evolution of confidence. This is business confidence, and 100 is the long-term average. You see a significant improvement in 2017. Same thing for consumer confidence. And the most impressive one is the image of France among global headquarters, so international image for international investors. And the blue line is a favorable answer. You see a dramatic change in 2017. So all of these are assets. But, and I now come to my second point about the French challenge, this momentum should not hide the remaining French challenge, which is very close to the one facing the euro area as a whole. And this is, as I said, where what I can say about my country is probably of interest to all of us. We are closing the output gap. And you see in dark blue France, in gray euro area, it's very close from a cyclical point of view. So growth and employment now face structural limits. If I come to unemployment rate, and this is a comparison of the real unemployment rate in full line and NAIRU in dotted line, we see that unemployment rate is still much too high, about 9% for the euro area as a whole, as well as for France, and that a dramatic demand request is to decrease the NAIRU. I will come back to that. Another part of the same story is that we have to increase, as we are closing the output gap, we have to increase potential growth. This is, as we all know, a long-term trend throughout all the advanced economy, but it's stronger in the euro area and in France. We have to decrease NAIRU and to increase potential growth, and this is the task of reforms, structural reforms, and no longer of cyclical stimulus, be it monetary or fiscal. This is for all of us probably an obvious economic message, but it has political consequences. As we all know, that structural reforms are more painful and take more time to deliver. And on some elements of these structural reforms, I will be close to Rob's message this morning. So let me come to the third part about the French reforms. As they are underway, and as I do see them as a fully independent central banker. There is fortunately a large overlap between what is underway and what is requested according to the Banque de France, but if necessary, and we all know this is the role of independent central bankers, to say what should be strengthened, how the government should be stimulated on such aspect where it has to go further. Our reform strategy is quite simple to sum up. After other European countries, along some other European countries, and here obviously I think to Germany some years ago, I think to the Netherlands, I think to other Nordic countries which have been successful in such reform strategies. We have to combine what I would call the European social model, which we have in common, and economic success. And all the countries I just quoted are clear signs that we can have this successful combination of European social model, which is an asset, and economic growth. But there is a prerequisite for any successful reform policy. And this prerequisite is overall consistency. Let me elaborate somewhat on the components of this overall consistency. There should be consistency between national reforms and European reforms. I will come back to that later. It's an addition, it's an and, it's not an or. Second, and we all know that, there should be consistency in timing. And in France, there have been some previous efforts, probably not enough, but I will mention some of them. And this government is clearly committed on a 5-year program. And there should be consistency in substance. So I sometimes sum it up with this slide, which is an hexagon, as you see, and some of you are probably aware that from a geographical point of view, France has the shape of an hexagon. So it's a quick way to remind my fellow citizens what we have to do. I will not elaborate on all components of this hexagon, but let me focus on some of these priorities. First, public finance. Here, the public debate tends to focus, in my country as in each country, on the level of taxation, and sometimes on the level of deficit. But this is not the key factor. The most important one, the most important driver, is the level of public spending. And here, the French challenge is very clear. We have more or less the same European social model as our neighbors, with a high level of public services, including in education, with an efficient redistribution, with labor relations, but the cost of this model is still too high. We tried to elaborate a bit about the difference in public spending ratio between France and Germany, which is about 13% of GDP. A small half of it, and this is the dark part, can be explained through historical or demographic factors. But the remaining part, about 7% of GDP, refers probably to smaller efficiencies of some public policies, be it in social policies, in housing, where we have to make progress, or in education. We go in the right direction with the diminution, as you see, of the increase of public spendings in real terms through since the year 2000, from about 2% yearly, which was much too high, to a promise by the present government of 0.4%. On this point, we must clearly, I stress it, go further, and we should reach a stabilization in volume of the evolution of public spending. Some ongoing reforms, public deficit down to 2.9% in 2017. This was a very old request from European partners of France. This was a commitment from this new government. It has been fulfilled, but we must go further. A reduction announced of the ratio of public spendings to GDP by 3 points in the next 5 years. We should do at least that. And on the tax side, and this is positive, in this budget, a reduction of the tax burden on corporate income to 25% in 2022, and a suppression of the wealth tax, which was too heavy on financial investment. I now come to goods and services market. Here we have clear and interesting OECD comparisons, and we are all aware of that. France and Germany have been making progress, but we are still not at the optimum. In energy, transport, and communication, the French comparison to Germany is quite unfavorable due to the presence of important state-owned companies. If we looked at services, I could have added it with regulated professions. It's the opposite image with a German positioning, which is less favorable than the French one. But clearly the trend is positive in this field of products and services market. And let me stress that I don't know if you are aware about that Mr. Macron was a junior economy minister before becoming president, and his first coup d'éclat, if I may say it in French, his first political victory was this quite famous in France Macron law passed in 2015, which was precisely about deregulation of goods and services market. So expect on this front a strong conviction from the present political team. If we look now on regulation of the labor market, and these are again OECD comparisons, here the relative position of France and Germany is the opposite one. And can I mention some ongoing reforms which have been quite impressive in recent months? First, and you heard about it, this labor market reform passed by the new government as a first priority last summer, passed in September, and, this is really impressive, implemented as early as November. And everybody expected a significant social unrest and contest of these laws, but they have been passed and implemented. The government announced a reform of unemployment insurance, and I will come back to it. This is obviously a key part of a reform agenda. And I pay tribute to the former government. a credit tax called CICE, Crédit d'impôt pour la compétitivité et l'emploi, has been developed in the last 3 years and has been very effective to reduce labor costs. If I look at the goods and services market as a whole, we have to do more. We have to do more in Europe as a whole. We have to do more in France and Germany in terms of simplification, and we know there is still much too much red tape for entrepreneurs. We have to do more to foster innovation, where we lag behind the United States, and I will come back to it. We have to develop a common financing of research and innovation. I now come to a last nexus between labor market and education and lifelong training, and this is a key nexus for employment. We have an absolute priority in the present cycle we are in the present expansion. It is to alleviate the labor shortage. And here you see the so-called beverage curves, which are very well known to economists. They show two things if I compare France and Germany. First, obviously, labor shortages on the vertical axis are higher in Germany than in France. But second, the beverage curve in France is much more to the right, and this is bad news. This refers to the fact that NAIRU is much higher. Another obvious comparison is the share of apprenticeship. And here there is a clear gap between Northern European countries and Southern European. If I may, Mr. President and Axel, I will include Switzerland for this purpose in the Northern European countries, because, as you know, it's the homeland of apprenticeship. But there is a direct inverted relationship between the number of apprentices, which you see in blue, and the level of youth unemployment. So there is no more urgent reforms in France and in other Southern European countries than to develop apprenticeship and, more broadly, lifelong training. This belongs, luckily, to the priorities of the Macron's government for this year. They announced a reform of lifelong training. They announced an investment from public funds of 14 billion euro to lifelong training and a reform of apprenticeship. But I stress it again as a stimulating central banker, these two reforms, lifelong training and apprenticeship, should go as far as possible beyond any bureaucratic and corporatist resistance there could be, because this is the priority to lift labor shortages we already see. If we combine three elements which have been successfully combined in Germany or in the Netherlands, firms' flexibility, and this is the importance of the last labor laws. Second, lifelong training, and this is the importance of the reforms to come. And third, employment benefits in order to give more support for labor mobility and more controls. These three complementary components are efficient to reduce structural unemployment, are efficient to reduce NAIRU. If we look at Germany in the last 15 years, it has about cut by half its level of NAIRU from 9 to about 4 to 5% today. This is, as a whole, an ambitious agenda. It's badly needed. It's not yet done. But there is a strong acceleration from the present government. And it's my role, if necessary, as an independent central banker to stimulate when necessary. But to put it in a nutshell, I would say that Europe and Germany have now with France a reliable economic partner. National reforms are an absolute prerequisite. There should be no doubt about that. But as long as this prerequisite is fulfilled, it brings me to the consistency I mentioned earlier, and to the last requirement for economic adjustments in Europe. We have to strengthen the Eurozone. It is now or never. We will never have more favorable economic and political conditions to achieve a strengthening of the economic union. Let me elaborate somewhat to conclude on the why of this strengthening and on the how. Why? Because if we don't strengthen the economic leg, the monetary leg is at risk of being overburdened. By the next recession, it will come one day, even if we have a robust expansion in the euro area at present. By the next recession, monetary policy will be at risk of being overburdened. This is a German worry. This is a German worry I can understand and share, and this is a worry which should find its solution in a strengthening of the economic union. How can we strengthen this economic union and elaborate on a broader economic toolbox? I stress the importance of national reforms, obviously. But we need some European accelerators. There are many ideas. I will not elaborate longer on that. Can I only wish that we go beyond old cliches on this debate, because it's not a new debate. And you all know the old cliches. On one side, German rules, on the other side, French expenditures. I could be rather more sophisticated, but it's a good sum up. We have, at present, important elements to go beyond these old cliches. I say it very simply. Strengthening the Eurozone is not about a transfer union. It's not about Eurobonds. I don't think these are useful perspectives. But if I look at Mr. Macron's Sorbonne speech, if I look at some elements of the last GroKo agreement, and I will not make any political comment on the German situation, I only look at the European part, I think we have interesting elements for a common discussion. Let me insist on one element of what could be our common innovative thinking in this field. And this element is shared with Jens, you mentioned it this morning. It's shared probably with the whole Governing Council. It is the idea of capital markets union and, in a broader sense, what I would like to call a financing union for investment and innovation. Let me only remind you that we have important resources due to the external surplus, 350 billion euro for the euro area as a whole each year. We have significant investment and innovation needs. Here I quoted three of them: digitalization, scaling up of SMEs, inequities, and green finance and energy transition. The challenge of capital market union is to channel these resources, these private resources, to the investment and innovation need we have. This is mainly through equity. This is private risk sharing for the most important part of it. And if we probably share a regret at this stage, is that this capital market union, or in a broader perspective, this financing union, seems to be a bit forgotten in the political agenda about economic union, which we see in our various countries or at the European level. Capital market union should not be the forgotten child of the strengthening of the Eurozone this year. Let me conclude by quoting the famous sentence by the former US President Theodore Roosevelt, and you probably know it. Quote, "In any moment of decision, the best thing we can do is the right thing. The next best thing is the wrong thing. And the worst thing you can do is nothing." It is obviously slightly exaggerated. but it is a welcome call for action in the expansion, I would perhaps say, despite the expansion. We should be confident, but not complacent. France is now at one of these moments of decision, and so is Europe. Thank you very much for your attention. 3 minutes of questions, or I don't know if that.
Okay. The speaker gave us 3 minutes for a question or two. May I ask you to ask the question soon and to be very, very short? And please identify yourself.
I can start anyway. Thank you. Thank you very much for this very interesting presentation of the French economy, European challenges. Just one brief question. I had two, but I reduce it to one only. And that is about, you mentioned in the beginning, the potential output that should be increased. And what's your current estimate, roughly, for the French potential output of, and maybe if you can add, what about demography in France? Is that a real challenge? Because I think it wasn't mentioned in the past minutes. Thank you.
I could come back to the curve I showed. As you know, it's always difficult to estimate precisely potential output. And is it a bit more than a midterm average? Okay. But having said that, our calculation, and obviously it's not enough, is about a potential growth of, I would say, 1.25, 1.3, which is not enough. So we are much above that. We were at 1.9 last year. Because we are closing the output gap, we are confident we will keep a significant growth above potential output, but we all know this is not a lasting situation. So the best solution is to increase potential output. Demography will help, probably, and this is of a paradox because France has one of the best demographies in Europe. It's not strong enough, and we all know this is a common European challenge, but in relative terms, France has the best demography. So it should help, but we must have a more productive combination of our production factors.
Sean Egan from Egan Jones Ratings. Let me suggest, and I'd like your reaction to it, a different template for looking at this problem. And that is one of national champions. Germany has more apprenticeship programs because it needs them. In other words, it's not successful because it has the apprentices. The apprentices are there because it needs them. Why does it need them? It needs them because the auto industry is a massive generator of jobs and wealth. It's about $6,000 per year coming into Germany. Per family, if you have 2 cars, it's more than that. Have you got some thought about the question? Yeah, this is the question. Have you thought about reversing the analysis and saying, well, maybe we should look at the national champions. Maybe that's the underlying reason for bringing up the growth and not policies, that the policies follow things. It's really locating strong industries in France because that's what Germany has ultimately done. Thank you.
The short answer is yes and no, but I will elaborate. About your expression of national champions, can I stress one thing which is not very well known? If you look at the number of large corporates which have worldwide significance, it's about exactly the same in France and Germany, which is a French advantage because the French economy is slightly lower or smaller than the German economy. It's about 35 large worldwide companies. Then there is a question you touched upon. The repartition, the sectorial repartition of these large companies is not the same. It is more industry in Germany, more services in France, including financial services. But if I come to apprenticeship, you need apprenticeship for industry. Obviously, here you are right. But you need also apprenticeship for other sectors, including services, housing sector, and so on. So I'm not sure it's a question of national champions. I am perhaps too economical or consensual, but if I had to express a wish that you act on both fronts, you need an apprenticeship reform, so without any doubt, including for SMEs. It's not only for national champions. And you need some kind, I use these words with caution, you need some kind of industrial policy to foster European champions, perhaps. One last remark on that, if you look at corporate demography in our two countries, again, the difference is not on large corporates, or there is a slight advantage for France on large corporates. It's no longer on startups and SMEs, on the contrary. It's on Mittelstand. And where Germany has a huge advantage is the ability to grow SMEs to what we call ETI, Entreprise de Taille Intermédiaire, or Mittelstand in plain English. And then when you come, it's this way. The German demography is this way, the French one is this way. But this is more a global favorable policy, including the 6 parts of the hexagon I showed.
Well, thank you very much, Monsieur le Gouverneur. We will... We will keep what you called the French momentum by inviting Marc-Olivier Strauss-Kahn and his panel to the floor. Thank you very much.
As you want. Where is Volker? Peter? I miss Volker. That's why. Okay. Wait. Can you put me in? So, good morning. It's still the morning. Pleasure to share this panel on global monetary policies, similarities and divergences on the way to the new normal. The title offers apparently a simple roadmap to structure the debates, but also some complexities and some puzzles. I'm trying to get the next slide. Okay. And so my role will not be only limited to introduce and check the clock, but I will be stringent on that because we need to keep time for questions and answers. The simple road, I'm struggling with the thing. Can you put, please, the next slide? The simple road, the next one, suggests to assess. Can you put the other one, please? To assess what's similar and what's different in the content and in the timing about where we are, where to go, and the way from here to there. The simple answer would then be to recall that the US was the first epicenter of the crisis, 2007-2008, which spread then to Europe and to the euro area, where it was compounded by the sovereign crisis, which created a sort of time lag of about 3 to 3 years with the United States. The two central banks having a similar target in terms of inflation, the Fed has often paved the way for the ECB, both in terms of errors, remember the taper tantrum, and most importantly, of strategical success, of normalization, with the end of QE tapering in mid-2014, and the first rate hike by the end of 2015. Thus, the ECB shall mainly adapt the appropriate lessons with due regard to the differences in the cyclical position and the structural components. Basically, the apparent divergence masks great convergence between the two parts of the Atlantic and contributes to smoothing too rapid global tightening. Yet, experts and markets may think that things are not that simple. It's not sure that we all agree on where we are, and there are many elements which will be discussed, including the persistent low inflation, the difficulty to assess the gaps, the slope of the Phillips curve, to quote a few of them. Neither is there a real consensus on what is the new normal. There are discussions on the equilibrium rate levels, R star. There will be discussions on the role of rules, the balance sheet size, the toolkit that we should use in the future. So it remains also very important, and that's the third element, and hard to communicate about the speed and the path with what I would call, quote unquote, central bank addicted markets. Moreover, and that's the last point, the title itself spots at least two puzzles. One is that while monetary policies are domestic and have domestic goals, it speaks about global monetary policies, and we understand, of course, that this is related to the spillover effects, the interdependencies over the world, and the contribution to global financial stance. The title also speaks about divergences and not only about differences. And this is not only due to the timing difference that I evoked before, but also to the fact that starting with different structural backgrounds and aiming at not exactly the same target, a dual mandate for the Fed and an asymmetric and only one for the euro area, this may create the impression of a divergence. Last, I'll add to this ingredients related to fiscal, structural policies, and market expectations. For instance, views may diverge on the impact of the US reform, whether it will be short or long-lived, depending on whether it has an impact on the supply side and not only on the demand side. And the expectations drawn by the market from the Fed experience may also affect the ECB strategy. To disentangle these puzzles, there is nothing better than this panel of four personalities whose CVs do not need to be recalled. The best may be to give the floor first to non-central bankers, Volker Wieland from the German Council of Economic Experts, and Hugh Peel from Goldman Sachs in London, admittedly with a previous incarnation at the ECB. And then two central bankers, Dave Altig from the Atlanta Fed and Peter Praet from the ECB board. And they will react and develop their own views. So Volker, if you want, you have the floor.
Thank you. I want to respond to the questions Marc-Olivier put up right at the start. Right? I'll start with the question where to go, right? The new normal, what evidence do we have in this regard, and then how far along are we, and are there any particular strategies to go there? So in terms of the new normal, President Kaplan mentioned that a number of times, a key element is this neutral rate in nominal terms. And since central banks in the US or in Europe, although they don't quite agree on what measure of inflation they look at, or don't exactly agree on the number of inflation, it's more or less pretty close. So the main issue is then, so what is the real part of this equilibrium rate? And as many of you know, I mean, there was some quite influential work by Thomas Laubach from the Board of Governors and John Williams, president of the San Francisco Fed, which suggests that this has really changed, this equilibrium real interest rate. And actually, Janet Yellen has used this in presentations when she tried to link policy rules and the policy stance at the Fed, but also President Draghi, Vice President Constantio have referred to this work. So just to remind you, you see on the left side, we've basically replicated the empirical analysis of Laubach and Williams and for the US, and we've done the same thing for Germany and the euro area. On the right, and the orange line is basically one sided estimate. The blue line, so I'm looking at the US, and so the left panel is a smoothed average estimate, so a two-sided estimation. And you see that in 2009, this really went down. And so now it's 0. So at the time, in speeches 2014, 2015, Janet Yellen said, look, if my equilibrium rate is 0, then we're about right where we are. Right? So then there's actually not that far to go. Right? Then the nominal rate is maybe 2. So the US is almost done from that perspective. And it looks kind of similar on the right-hand side for the euro area. Our estimation turns out a little higher, replicating Laubach-Williams for Germany and the euro area. But it seemed to have declined. Now, when John and Thomas wrote their research paper, it was actually in 2003, and they very much emphasized a different aspect. And the aspect they emphasized was that these neutral rates, when you try to estimate them, they are associated with great uncertainty, and hence they should not be used as a benchmark for multi-policy. That was the conclusion of their paper 2003. And you know, if you listen to Thomas or to John, that when they give speeches, they always refer to that uncertainty. But all the others who've picked that up, like Larry Summers, Paul Krugman, Janet Yellen, the speeches of Mario Draghi and Vito Constantio, they don't really mention this uncertainty. So I think the uncertainty is actually very wide, and I want to draw your attention to this dotted points, which is only the 86% confidence interval. And that already tells you that the decline from 2% to 0 in 2009 is actually not significant. So that should give us cause to think. And if you now look forward, where do we need to go? Maybe, from that perspective, okay, we're almost there is a little too optimistic. So if you want to worry, maybe you should worry about that there's further to go than these estimates suggest, just from the uncertainty. Now, there are more studies who have that, and when I had a discussion with John Williams in Stanford, he said he brought along 5 more estimates which look similar. So they were probably also not that much more significant, but I thought I need to bring along something which does look different. So that's what you see in the next slide. So just for argument's sake, the methodology they used is kind of a structural vector order regression, or a simple Phillips curve IS model with a lot of unobservable moving parts, like the equilibrium rate, potential, etc. So here we took a model, a more structural model. Here it's a particular model of the Smates, developed originally by Smates and Wouters. And what we do is we look at the very long run equilibrium rate. These models have a steady state growth rate, a steady state equilibrium rate. So we look at the model identified estimate of this steady state growth rate. So when Smates and Wouters did that in 2007, or they published the paper in 2007, this is estimated also for the US, they got this magenta line, they got an estimate around 3% of the long run steady state. Now, things may change anyway, so we actually re-estimate that model with 20-year windows every quarter, right? There may also things may change which are not in the model. So if you look at the dark blue line, it's really re-estimating many, many times with the real-time available data vintage in that quarter, this model, and always looking what's the equilibrium real rate. It'll depend on what? It'll depend on the potential growth rate that model gives you, which basically comes from productivity growth, technological growth. It depends on preference parameters, discount factor, the risk aversion. And you see it moves down, it moves up a little beyond the magenta line, it moves down. It moves down to from 3 to 2, so there's a decline which comes with a decline with the long-run growth, which you could attribute to a number of factors, maybe aging, maybe something else, maybe lower productivity, just because we haven't figured out how to use these new technologies, these disruptive technologies, really efficiently. So there's a decline, but it's way less than what Laber and Williams with their methodology find. There are others who do that. We also look at a model by what's the name? And you come back to me. Del Negro Schauffheide, where they also include data on risk premia, corporate bond premia. They talk about the convenience yield, and when you use their model, we get a decline to around 1.5%. But so that still means the risk is on the upside, that maybe there's much further to go than the Laber-Williams estimate suggests. And also these blue lines, as you see from the light dotted lines surrounding it, those are 95% confidence intervals. So that according to that model, that's a pretty precise estimate saying that the equilibrium rate is positive, not 0. It's significantly positive according to this. Now, what's interesting is with these models, you can actually figure out a story. You can tell a story, just like President Kaplan said, well, my story is aging, so we can look at this model, what's the story of this model? And in particular, not only about the decline of the neutral rate, but the decline of actual real rates. So if you look at the orange line coming down to a level of about 0.4%, that's the average short-term real interest rate. So Fed funds minus expected inflation. On average, this is a 20-year average because every data point is an estimate of the model over a 20-year period. So the last point, the finishing point on the orange line is basically from 1997 to 2017. So we're at an average real rate of 0.4% for the US. So what explains that? Now the model has a story. That's what you find in the table. And the model says, well, it's about 1/2 multi-policy. Multi-policy, according to this model, is a big part of the story. Another quarter is risk premia, so that relates to the convenience yield story you get in the other model, where you get the endogenous data and the Del Negro Schauffheide model, and then there are a bunch of other factors. But so you see, my point here is, well, don't exclude that maybe multi-policy, even though real interest rates have now been low for long, is still a big part of the story, right? So if you change multi-policy, that changes things. That was a question where to go, where are the risks, maybe the way is further. Then where we are, this is a look at the G7 plus a few others, because the euro area is there. So there's the euro area, Japan, UK, Canada, US. And just 2 short points. The pillars are basically a look at the increase in central bank balance sheets. This goes to show, you see the line still going up, so worldwide, or the big economies, central bank balance sheets relative to GDP are still increasing. The main contribution is, of course, not coming from the US, so they've moved further in that account, but they're coming from still the euro area and Japan. So we are, in this large economy is actually still in expansion mode. The top is a bit of a comparison. So the magenta line is weighted policy rates, and you see they have barely lifted. This is 2017, like November, so there's a little more. But even though the US has been moving up, over this range of countries, it doesn't show very strongly yet. The range of dark blue line and the range around it, light range around it, is a range of reference rule, Taylor-style reference rules. This is an exercise that BIS has done a number of years, and we've just repeated it. Basically says, well, let's estimate trend growth rates. They change. Let's use that as the R star. let's use different measures for inflation, let's use different measures for trend growth and output gaps, throw that all together and see what range of reference rules you get. That's the range of blue. And then we do this not just for one country, but we average over these 7 large regions. And you can see the blue region in the last year and a half has really moved above the magenta. Right? Inflation has recovered. Maybe it's not at 2%, but it has recovered. So you see a real policy easing there in real terms. Right? So in a sense, it's from that perspective, it's not just where we are, but policy has become more expansionary according to that benchmark, and it takes into account some decline in the neutral rate. I have some more analysis on the ECB. We don't need to go there in a lot of detail. It's too many lines, but just relative to such benchmarks, it's more a lower for longer policy. Now, maybe one thing which is interesting, because we talked about these, neutral rates. And with these neutral rates, there comes a potential estimate. And so I want to draw your attention. There's a green line which moves up. That's the output gap estimated by the European Commission. We've talked about that earlier today, right? And President Weidmann referred to the OECD estimate, which is a bit higher. So when you refer to to Laubach-Williams neutral rates, you should also look at their potential and their output gap. And if we apply their method to Europe, to the euro area, you get the orange line, you get the light green line, which says medium-term output gap. So you see that analysis actually says that output in the euro area is over 1% above potential. Now, I'm not asking you to believe that. I'm just saying, if you believe the neutral rate is 0, you should believe that too. So maybe there are some doubts. Anyway, and if you feed that in reference rules, you get more a situation of being behind. I still have a minute or two. Yeah. We also, maybe 2 quick points. You don't have to read that in detail, but so a lot of this is maybe pretty standard, but we thought, what's the strategy for policy normalization? In terms of sequencing, there is no difference, although I would say that I think once you are in the position of raising interest rates, you don't need to wait necessarily much longer to reduce the asset holdings. I think we can keep it open how to do that when we get there, but the sequencing, there isn't much of a difference. But there's an issue about symmetry. So we think, or I think in that sense, because this was also contributed to our council, to our annual report, so the others signed on to that too. But so we think there is more reason for symmetry in reacting to macro developments in a balanced way. So not just inflation, but also output. And maybe I should add that in the past, I've certainly done research which argues for asymmetry. Right? We, at some point, 17 years ago, we wrote a paper where we did optimal quantitative easing. Wasn't much noticed because it was such an exotic topic at the time. But so we looked at an optimal quantitative easing. It turned out that it was also optimal to ease interest rates early and then to keep them lower for longer. The key factor in that model-based analysis was that we introduced uncertainty about the effects of quantitative easing. Now, compared to 2000, we have now more certainty about the effects of quantitative easing. So maybe that's one thing. The other thing is in that analysis, where the lower for longer was to guard against deflation risk, we didn't look at negative consequences from keeping interest rates very low, maybe via inducing some exaggeration in asset prices or in credit growth. So I think if you take that also into account, so we would argue for symmetry. And so, for example, the ECB at some point said, well, we're going to go back to more purchases if things turn out worse. And symmetry would say, well, if things turn out better, then you just could stop them earlier. One thing and it was interesting, we had also the pleasure yesterday have an event with President Kaplan, and there's this issue about forward guidance, and we thought we could enhance forward guidance further in Europe, doing forecasts also for interest rates. It's a tricky business if you do it like the Swedes or the Norwegians. You have to get everyone together, but one could at least do a survey like they do at the FOMC, among the board members, governing council members, what do they think about growth, inflation in the euro area, and interest rates? Why not? The answer I always get, look at the US, they've been wrong. For a German, that's easy to understand. In Germany, you learn, don't make mistakes. Right? That's the worst thing. So I don't know. Maybe it's everywhere like that. It's just like when I grew up. But so President Kaplan. So I said that to President Kaplan yesterday, and then this was in public, so I can quote you, right? So he said, "Yes, but I'm coming from the business side. I know I make mistakes, right? I mean, you just want to see the heterogeneity, and I think the heterogeneity would be very interesting for Europe too. So that's one little point. I think." Maybe one point just to conclude, what's the consequence if we normalize? I mean, we, the euro area, I mean, we have to look at the member states also because they're very heterogeneous. I mean, Governor Villeroy made also that point, among others, right? That there's a significant heterogeneity. And so here we did an exercise for Italian government bonds and Spanish government bonds. And so the light blue is the interest rate, the interest expenditures. They have come down, right? They went up in 2012 during the European debt crisis, but they've come down partly, of course, partly due to, or to a large extent due to multi-policy, but also due to hopefully reforms and faster growth, at least in Spain, which justifies lower risk premia. But then we do this exercise. We look at the outstanding then the new sovereign bonds, government bonds, newly issued government bonds since 2002, that's the dark blue line, so that's that segment of government debt. And then from 2017 onwards, we do an exercise, what if interest conditions stay the same? What if the yield curve shifts up by 1%, 3%, 5%? When does it get painful? You see, if things stay the same, so they haven't quite stayed the same since November, but if they would stay the same, actually interest cost is coming down. That's the orange line. If it moves up by 1%, very easy to manage because it's just the same level as it was maybe just 1-2 years ago. But from 3 to 5%, so 3% is something maybe to take into account. So a 3% shift up of the whole yield curve does present a challenge, particularly to a highly indebted country for Italy. That's why it would have been so good, or would still be good, to use the interest rate savings to reduce debt rather than to finance expenditure. It will also make the job of the ECB much easier. I'll stop here.
Thank you very much, Volker. I give, for the sake of time, immediately, may I get that? The floor to you, who will present the bankers or the markets view.
Thank you very much. So first of all, let me say what a great pleasure it is to be here, and thank you for the invitation. And it's a great privilege to be sharing the stage with such a distinguished group of fellow panelists. Volker has talked a lot about the strategic aspects of monetary policy, and I thought I would try and complement that by saying a few words about the more tactical issues in monetary policy. Especially over the last few days, in the type of job I do on a day-to-day basis, it feels like anything that lasts beyond market close is strategic. So, I mean, I think naturally I am in that domain. And what I wanted to sort of focus on, which is quite a narrow issue, but does draw on a number of things that Volker has said, is how central banks communicate around liftoff. Now, what do I mean by liftoff? What this chart shows is various forward curves for short rates in the euro area. So I'm focusing here on the euro area. It also includes the Goldman Sachs forecast. That is not necessarily of import at this point. And I think that the interesting thing is that these forward curves look quite parallel in the future. So what is really happening in terms of communication about monetary policy at the moment, in our view, is largely changing the date at which the first move up in rates is taking place. And that is what we think of as the lift-off date, for reasons I'll expand upon in a moment. And we talked earlier about monetary policy should not be overburdened with too many things. I think that's true. I also think that we need to recognize, and certainly I think this is the market view at the moment, that monetary policy is quite a blunt instrument, because you really only have this one degree of freedom when you are going to start raising rates. It may be that in the euro area we have a transition of leadership issue, which leads markets to think we're going to be raising rates in a slightly more hawkish way than if we had no change in leadership. So, there are some institutional aspects behind this, perhaps. But I do think the reality at the moment seems to me to be that this liftoff date is key. Now, why is communication an issue around liftoff date? Let me just explain what this chart shows. I mean, it's quite akin to things that Volker has shown. The blue line here is the time series for the ONIA rate, so basically the operational target of the ECB. The blue dots around it are what we have estimated as a policy rule for the ECB. This is a descriptive policy rule, not a normative policy rule, and it has some bells and whistles associated with it, which I will not go into. It's estimated essentially over the pre-crisis period, so unsurprisingly, it fits the data well. That's what all regression-type exercises do. But as you enter the crisis, and crucially by the time you get to the sovereign and banking crises, this rule would suggest you have a deeply negative rate, much deeper than the ECB has been prepared to entertain thus far. So the blue dots go well below zero. And I think the point, which is well understood, is the ONIA rate does not go well below zero. There is some sort of lower bound. Now we can discuss what causes that, we can discuss, but in practice it does seem that that has been the case. So according to this chart, and this happened according to this chart later in the euro area than equivalent exercises would suggest in the US or the UK and other jurisdictions, as of 2012, policy was insufficiently easy by historical standards because of the constraints of the lower bound. And that continued, through 2015. And I think the kind of point here is rates became insensitive to data. They became insensitive to downside shocks to the data because you couldn't lower interest rates because of the lower bound. But they also became insensitive to upside shocks to data because the shadow rate implied by the rule was well below the actual rate. So you actually wanted a lower rate than you had. If you got a positive shock, you didn't want to raise rates anyway. So this was kind of what we call an absorbing state. And it was a constraint on policy which was dictated by reality. Then interestingly, by the time we get to 2015, 2016, this shadow rate goes positive again. The improvement in the macroeconomic data, the recovery in the euro area, allowed this rate to be positive. But, and through some of the mechanisms that Volker was alluding to earlier, the ECB had adopted forward guidance. There had been a strong signal in the middle of 13 which was maintained that rates would be kept at low or lower levels, even in the face of data. And again, there's a lot of bells and whistles in terms of the machinery that generates this, but at a very simplistic level, there was a commitment of policymakers to deliver excessive ease relative to the historical benchmark in order to compensate for the excessive tightness that was not, the easing that was not delivered when they were constrained. And I think the crucial point about all of this is, in that period, rates were also insensitive to macro data. And indeed, the success of forward guidance was often tested by checking whether rates were insensitive to macro data. But that was not by accident, that was by design. So it was a policy choice to do that. Where does that leave you? It leaves you, I think, with two kind of practical communication problems. For all the reasons that Volker has talked about, at some point you will want to raise rates because the economy is getting better. But that is a surprisingly difficult thing to communicate because you've spent the last 2, 3, 4 years saying you're not going to raise rates because the environment is getting better. So there's a sort of inflection point in the communication which I think creates a difficulty for central bankers, as we've seen in other jurisdictions I'll show you in a moment. And then the second thing is that you get to the point, even after you've begun to raise rates, where again, not by accident, but by design, you have a lower rate than you would choose to have if you were landing from Mars and able to choose the rate that you would choose. I mean, if you look back to what happened on Friday, a surprisingly strong inflation number comes out in the US data, and the market response is the Fed is behind the curve. Now, whether that's a fair response, I don't know. We might hear about more about that in a moment. But the market thinks that that catch-up is going to have to be accelerated. But the point is, there's an inherent nature as if you've been lower for longer, you are by nature behind the curve relative to the historical benchmark. Now, of course, it is also true, and Volker dwelled on this, and I won't say much, that the historical benchmark may be the wrong benchmark. The next phase in this chart is the new normal, and maybe the new normal is different from history. Indeed, if history hasn't delivered what we wanted it to deliver, it should be different. Mr. Trichet would say the historical benchmark delivered inflation of 1.99% over his tenure. it also was associated with the emergence of a big financial crisis. So you can have your cake and eat it if you want. You can depend. But I mean, I do think there are some issues there. But at least as a benchmark, I think this picture has some role. So let's just briefly look at the first problem. How do you communicate the lift-off? I mean, the most proximate central bank that's done that was the Bank of England, which pre-announced in September it was going to raise rates in November. That came as a surprise to markets. Now, we might say sometimes we need to surprise markets. And indeed, many market participants like surprises if they're on the right side of them in their positioning. They don't like them when they're on the wrong side of their positioning. So, you can, again, take your pick there. But it's clear that I think from a gradual, smooth communication point of view, this was a raised issue at the Bank of England. And I think the reason is pretty clear. What this chart shows is macroeconomic data surprises in the UK, essentially the deviation of data outturns from what the Bloomberg consensus expected ahead of the print of the date, weighted by the impact of that surprise on the 10-year rate in the UK. And so what you can see here is, fortunately, from the bias of the Bloomberg indicators, over a long period back to 2007, that's what the green dots show, on average, these shocks are basically zero, right? But in the period post the UK Brexit referendum, which is the vertical line in the middle, those shocks were on average much more positive. Lots of people, including us, unfortunately, thought that the UK economy was going to weaken significantly post the Brexit referendum, and it hasn't done so. But the sort of crucial point from this is that the positive surprises went on for a very long time. And in fact, the Bank of England cut rates and held rates at this new lower level throughout that period. In the August inflation report, which is the vertical line 2 from the left, the Bank of England was still, at least on our reading, suggesting that it was in this lower for longer phase. The news between the August inflation report being published and the pre-announcement of the November hike at the September meeting was not that positive. Indeed, that's reflected on average in this red line. Not only was it well below how positive we'd seen since the referendum, it was actually below the average positive response going back to 2007. Admittedly, there was some good news at the end. So I don't think it's the point I'm trying to make is that it is very difficult to say we choose to lift off with rates in November 17 because the marginal information we have in November 17 versus August 17 is significantly better. What you're really choosing to do is we're going to lift off rates because the cumulative information over the last year has been better, but inherently that makes it difficult to communicate in a data-dependent way what the timing of the rate hike will be. Now, my view is, and we may hear more about this later from others on the panel, is the ECB has evolved quite an elegant way of dealing with that. I think it's self-evident that the macro data are improving. I think it's self-evident in the manner that Volker's described that that creates a strategic case for starting normalization, including the normalization of rates. And what the ECB has done on our reading is it is using asset purchases, and particularly the longevity of the asset purchase program, as a way of giving a quite clear signal to markets when they expect, in this Odyssean forward guidance way, they expect at this point rate hikes will be. And just to make that very blunt, if asset purchases stop in September and we maintain the well-passed language, that is a signal for a March rate hike next year. If we see asset purchases spin on to the end of the year, that's a signal for a June rate hike next year. And that seems quite elegant to me. I mean, perhaps elegant is too strong. It's quite effective to me. And then I just wanted to go to a second point, perhaps more addressing the US side, which is go back to this point of catch up. And I think this draws on a number of things that President Kaplan was talking about. If you have to catch up, there is a secular upward trend in interest rates that is going to be there. There's going to be an upward trend in interest rates, which to some extent is independent of the macro data. You need to get to a higher level of rates, even if the data don't come in strong, because you're still responding to that accumulation of the recovery in the past. So one way of doing that would just to say, we're going to raise rates at every meeting by 25 basis points. I'd be interested to know what Mr. Altig thinks about this. But I think that's what a lot of people in the market thought Alan Greenspan said in 2004. Now, on some dimension, that led to a very smooth evolution of rates. But I think if you have people, and there are lots of people in my business out there who are prepared to borrow short, lend long, if you have a short-term yield curve which is upwardly sloped, and you take out all of the volatility from it, that's a very big incentive to lever up in that position. And if the private sector, outside the financial sector, demand for credit is not growing in parallel, and it was growing strongly then, but not strongly enough to satisfy this demand to exploit the risk-free return, risk-free in inverted commas, offered by the upward sloping yield curve, what was the consequence? A strong buildup of intra-financial sector leverage. And that might not have been the proximate cause of the financial crisis in 2007, 2008, but I think it was an important vulnerability and an important accelerant of the crisis when it took place. And my concern would be that maybe we're entering a situation where we could be facing those types of things again. I don't know. We might say, and this is the conventional wisdom, we have better regulation, we have macroprudential policies. I think all of that's true. But in line with what President Kaplan said, maybe what this is doing is squeezing that re-leveraging into other less regulated parts of the financial system, which actually could be more difficult to manage if there's a problem. But then what's the alternative? Well, you want to have some volatility in the market. You want to have some uncertainty about how you're raising rates. Maybe that means you should respond to positive shocks, the economy, more aggressively than to negative shocks, so that you get this ratcheting up through time with still some uncertainty. But that's inherently an asymmetric response, at least on a short-term basis. And I think it goes against some of the well-established principles that Volker was pointing to earlier. So, I mean, from the financial point of view, I think that remains quite a big issue. And although I said I was going to talk about tactical things, and I've tried to do that, let me just conclude with one strategic observation, which I don't have a good answer to, so it's more a question to those that speak after me, is that I still don't think we have a good answer from the central banking world to how much monetary policy focused on an inflation target or a definition of price stability, appropriately given its mandate, how much attention can and should and will it play to concerns about financial stability of the type I've described, because there is a little bit of an inescapability there, I think. If we want to have this gradient which is smooth, gradual, predictable, etc., I think the danger is we recreate the problems, and maybe the policies designed to address them in the regulatory sphere end up not being as effective as people think. For example, a former colleague of Mr. Altig, Jeremy Stein, has said only monetary policy really creates the environment where you can get into all the cracks in the financial system. That, of course, would suggest other things equal a sharper catch-up, but it then runs into some of the issues that we talked about that the markets may not be prepared for that. So I agree with, I think, the conclusion that others made earlier. The crisis may be behind us, but we are in for interesting times.
Thank you, Yehu. Dave?
Well, thank you. It's a great pleasure to be here. Here's how I'm going to frame my comments. Yeah, so you'll recognize this. This is the summary of the dot plots from the December FOMC meeting. The red line there is the median projection for the federal funds rate path out through 2020. The gray bars are the consensus range. If you're counting, you get about 3 rate hikes this year from that chart. And I will tell you that my job at the Atlanta Fed is to basically do forecasting sort of things. I have to write down a monetary policy path in order to do that. You may not be surprised to hear I've written down 3 rate hikes. So what I want to talk about is what would make me change my mind, not knowing what the committee is going to do, about how many rate hikes might be plausible to write down. I want to make crystal clear, I speak only for myself. I'll speak for the staff at the Atlanta Fed, since I'm the director of research. They got to go around with whatever mistakes I make. But the rest of the Federal Reserve System, if you think I'm speaking for them, you are mistaken. So here are sort of the essential watch list that I'm thinking about in terms of the uncertainties about the economic environment and what it might mean then for the policy. First, is this going to be finally the year we get to 2%? And more importantly, is this the year we finally go beyond? Related to that is what is the change in the fiscal policy environment in the U.S. bringing? And then the final question is about R**. President Kaplan talked about that. Volker talked about that. I probably won't say much about that and focus on these first two elements. So here's the record. The dashed line there is the 2% longer-term inflation objective. We announced that in 2012. The inflation line here is, my preferred measure of trend inflation. It's the Dallas Fed trimmed mean, not because my colleagues are here, but because it really is sort of, I think, the best forward predictor of inflation. So the target was announced in 2012, and the world has completely failed in its obligation to cooperate since then. And in fact, if we borrowed the Martian and brought the Martian down to Earth and asked them, what do you think the Fed's inflation objective is? Well, being able to draw straight lines through the data, the Martian would say, well, it looks like 1 3/4%, raising actually, I think, legitimate concerns that expectations are not anchored at that 2%. Here are the results of a survey we took last year. At the Atlanta Fed, we run a business inflation expectation survey. It's of business executives in the Southeast. And we asked them the question, what do you think the FOMC is most worried about? Are they most worried about inflation running above 2%? Are they most worried about inflation running below 2%? Or are they equally worried, as they say, about inflation above and below this target? Well, you can see the results there. 38% said, no, we think that 2% is a ceiling in the mind of the FOMC and not the average of a target. And in such a world, if that is the dominant view, then even though the modal expectation may be 2%, the mean expectation is going to clearly be something less than 2%, again, reinforcing this concern that the big problem is inflation expectations are bounded below that 2%, with the attendant implication that perhaps inflation is going to have to run hotter for a while to attract expectations up to the objective. The economy has to run hotter for a while to attract expectations up to objective, and that means the policy path presumably would have to be more accommodative for longer. That's not my story. My story is going to be something more conventional. This is a picture which is basically based upon a speech that former chair Yellen gave in September. The dashed line there is the misses from the 2% target. So 0 is where we want to be, it's where we haven't been, and all the colorful bars are a decomposition of the misses on the inflation objective between import prices, that's the green, output gap, that's the red, inflation expectations, that's the blue, and the light blue, stuff happens. And that is the story of last year. Why did we miss last year? Stuff happened. It's a residual, outsized transitory effects on individual elements of the market basket. They were big. By construction in this exercise, of course, the blue goes away. It averages 0 over time. It's a residual. It may not give you comfort that you don't know what the residual is, but when you hear many of us say we think that the rate of inflation has been drawn down by virtue of transitory elements, that's exactly what we're talking about. So that should go away. That's my story. I'm sticking to it for now. Here's another bit, and I don't know that this box is helping much, but I want to focus on the green area. That's import prices. I think and that's at least in part a story about the value of the dollar. And you can see that particularly as you get into 2015, 2016, the appreciation of the dollar over that sort of episode mattered a lot in terms of drawing down a measured inflation in the United States. Now, I'm inclined to take President Kaplan's fine example and say I don't forecast the dollar. But of course, you got to put something in there. And if I listen to market commentary and then think about the global context of the rest of the world, the global economy essentially picking up speed, normalization, which, as we all know, starts first in the US and now is beginning to probably filter to the rest of the world, probably most people expect some depreciation of the dollar as a result of those dynamics. Meaning in this sort of chart, of course, that the green area is likely to turn from negative, drag on measured inflation in the United States, to actually something that will work in the direction of pushing up inflation in the United States. To the extent that that becomes a dominant part of the story, as it actually seems to have been a dominant part of the story in the other direction over the course of much of the recovery, our thinking about sort of whether or not we want to continue to obsess on low inflation may come to an end. And the other piece, of course, of that upside risk to the inflation picture going forward is the fact that slack in the US for sure, and in the global economy probably, is basically gone. Which brings me to the second point. What am I expecting out of tax reform? And of course, we got another fiscal policy bump, it looks like, in the US yesterday. Well, my answer is not much. So here's the result of another survey, this one not from the Southeast, but nationally. So we at the Atlanta Fed run a survey that I think we're calling the Survey of Business Executives. It's a nationally representative sample. We do it jointly with Stanford University and the University of Chicago. And in November, we asked the question, if tax reform passes in more or less its current form, which it did, how do you think this is going to change your capital expenditure plans? And you see the result there. The vast majority, 65%, said not. It's not going to change our capital expenditure plans. Well, of course, tax reform is a reality now. Reality tends to focus the attention in ways that conjecture does not. But I can tell you, and you can ask Rob kind of offline, or Mark, or any of my other colleagues here, whether or not they feel that they're detecting a different signal since tax reform has passed. This survey, by the way, is in the field now. We're re-asking the question. But anecdotally, I can tell you that we are still getting pretty much this answer, that tax reform is still a mystery to us. We don't know exactly what these rules are going to mean, and we are still in sort of wait-and-see mode. I'll note that also in this response, those that tended to say affirmatively, I'm increasing my capital expenditure plans as a result of tax reform, was skewed towards smaller firms and not sort of the larger firms. Whether that makes a material difference at the aggregate level, who knows, but them's the facts. Now, all of this is happening. So basically, you asked me how much I wrote in for the effects of tax reform. I think President Kaplan said something like 0.3%. Yeah, that's what I did too. So we're good, but the risk is clearly, I think, to the upside on this. And it's happening at a time where, at long last, we're at the point where we can say, hey, that was news we could have used 3 years ago when the output gap was quite large, there was a lot of slack, and now it's hitting at a time where the economy is more or less operating at what is arguably full capacity. This is a picture of the dark line there is the Congressional Budget Office estimate of the natural rate of unemployment. The blue line is the actual unemployment rate. And the red are these episodes of high pressure economies when the unemployment basically rate falls below equilibrium. President Kaplan also noted, we actually did not coordinate on this, but he also noted, these red areas, they're kind of interesting because they end badly, invariably. they end badly. So those are recessions, those gray bars that I just added to the picture. Find me a red period that doesn't end in a gray bar. You can't. Now, it's a picture. Correlation is not causation, obviously, so I always put this picture up. This is the relationship between number of people who drowned in a pool and films that Nicolas Cage appeared in. Personally, I think it's Nicolas Cage's fault, but you would be excused for believing that this may be spurious in some way. And a more serious picture is this one. There's the gray bars. This is the relative price of oil. Going back to the 1970s, every recession was associated with the end of a red high-pressure period, but also associated with a large energy spike. And there's a very interesting question in the U.S. now, is that all those other periods were not periods where the U.S. was a dominant energy producer. So even this picture, which historically is fairly compelling, relationship may be less compelling going forward, even if it's structural. So all of which it is to say, however, that the turnaround in fiscal policy, the stance of fiscal policy, the state of the world in which U.S. monetary policy is operating may look, and if I had to place my bets on the more likely probability, will look much different than it's looked over the last 5 years. At the end of the story, our star sort of kicks in here as to whether or not that's actually sort of the case. I will tell you that I'm used to thinking of our star as almost outside of the realm of both U.S. monetary policy and circumstances within the U.S., which is to say, I'm fairly convinced by the global saving and investment imbalance story, by the global risk-off, demand for safe assets sort of story. I think, if anything, we might be thinking in terms of a turning point in those stories as well. We'll see. Thanks.
Thank you very much, Dave. Now, Peter.
That's right.
Yeah, it works.
Yeah, we ready? Dave, I wasn't sure. You were talking in your own name. I mean, I'm not sure here, because what I try to do is give a sort of fair representation of the Governing Council views. So it's a more delicate exercise than to say I speak for myself. And that's what I always try to do. And then people tend to classify your dove or hoax and not. Try to do as fair as possible, because you're never sure, of course. And, but that's what I try to do usually. Try to explain a little bit what is, let's say, the common view. And we know there is a distribution into that, of course. But that's what I try to do usually. It's not my own view, actually. My own view. Only I know my own view. Well, you express it, but I don't. So let me try to go through. First, in a few points. First, things evolve broadly, according to our plan. I mean, maybe luck by luck or whatever, but I mean, frankly, it is according to what we thought some years ago. And given the lack of experience in many of these instruments, I can say that this, in a way, that's remarkable. So we'd say it works. Now, you only know much later, of course, history will tell and will judge, of course. But I would say so far, when you look at the numbers of uncertainties we had, and because that's a little bit when you look at your Taylor rules, augmented or not augmented, frankly, when you look all the shocks that we had in the Union, I think it's a reduced form representation where I have some doubts, I would say. And when we had this in April, I was in April for the ECB and the Watchers with John Taylor there, I can tell you, he said, I agree with you. It said, now when we go back to a new normal, then we may go back to the more John Taylor like in the US. I mean, he argued, of course, before the crisis, the mistakes that were made. Then you had these big shocks in the crisis where you had to think about that your estimates of the Taylor rules and the recommendations you show before the crisis, I would say before the crisis was maybe too loose. The Taylor rule was right. I mean, said you were right. If you take 11, you think we were right to increase the rates twice in 11 when the economy was falling? That was your Taylor rule recommendation. When banks start to reimburse the TLTRO, the liquidity, 3 years maturity, good news, they reimburse. Bad news, crunch, they cut their balance sheet, you see? So I think 2012, and I can go on, with the example. So I think it's a bit easy to forget what happened, a huge banking crisis, 70 years old crisis, I mean, never happened in 70 years, etc., etc. I just want to say. Now, first point. So things evolve broadly according to our plan. I think it's important. Germany, just to give a little illustration of today, I mean, I looked, Jens, at your estimates, kindly, the other Jens Weidmann, gave yesterday evening at the council, 3.3 this year, next year. That's the estimate, this year and next year. 3.3 wage increase. Very difficult to calculate, of course. So the range is a bit, from that, it's a little bit on the low side, and it depends because it's complicated to calculate. 3.3 is what we have basically in our baseline scenario. So people say, your wages are not going to go because the discussion is so much, too much inflation. If I follow your catch-up, recommendation, which is not a recommendation, that's unfair when I say that. But when the people in the audience see it, they see it as a recommendation, of course, a catch-up. So it's well, I know you nuanced, but the way you show it, you need to catch up to 3-4%. No, that's the recommendation you would. No, of course, you would not say that, of course. You can say we are too prudent and not too prudent, but one has to see what we communicate. 3.3 is what we have in our projections, and it's perfectly in the baseline. There were a lot of doubts about how wages will evolve in our baseline, and the question was not so much you get too much inflation. The question, you're never going to reach it in a few weeks ago, a few months ago. Now suddenly the hysteria goes the other way. Are you going to overmaking? But I can tell, I pass months and years explaining, well, our scenario, it's good change, our base scenario is going the right way, it will take time. That's my second point. We always knew that the process of normalization will be long, given the nature of the crisis that we had. Would be a very long process. And we know the longer the process, of course, the more the collateral damage can be. This we also know, and I fully take your points about financial stability and all that. I don't know myself. No, I talk for myself. I don't know myself how history will judge that. I don't know yet. But we are very well aware. But we knew it was long. The problem when it's long, you see, is that when you undershoot your objective, you always have a risk of de-anchoring. And I think you should not underestimate it. Maybe I show you one slide. Do you have your comment? No, not that one. They all know that. No, just on inflation, because I didn't come very much to inflation, I hear from my other panelists. That's on the left, one representation, you know it, is the HICP and the core HICP. We have plenty of measures of that. You did in the core some downwards drift. If you put it in level, and we are not price targeters, so don't misread that. I just put a 2% trend just to benchmark, and then I saw the headline and the core. And then you see, of course, from 13, 14, you see some drift, from the cumulative drift. As you mentioned before, by the way, a very good remark, because very often data come in flows, of course, by definition, and nobody reacts, but at some point it accumulates and it creates a tension, and then markets suddenly react. I fully agree with your point. It's the same with currencies usually. Little changes in currency do not really matter. Makes people nervous because they have positions. But at some point it accumulates to big figures, and then you have a more fundamental reaction. I fully take the point. But this is the same point I'm making here. On the left you say what's in the price, 1%, or what you go for 1.2, 1.2, 1.3, what's the difference? But then it accumulates over time. And that's the question of anchors. I'll show you another graph on inflation, which we had to face all over. 2008, you have the crisis. This graph, price of protection against deflation, price of protection against inflation. The yellow is protection against deflation. The blue against inflation. But you see, in some points on the crisis, people don't know. So the risk of inflation, deflation is quite high on both sides. At some points, the risk of inflation goes down. Nobody is ready to pay a price to pay protection against inflation, but well on deflation. This has gone, of course. But it's not by coincidence, that it's gone. It has gone, a big investment in policy, a lot of experimentation, a lot of risk that we have been taken. And I know I had a debate with Axel, he gone some years, 2 years, I think, and I say we also need the courage to act. That was the Ben's thing. He said the courage not to act, he said, also, you need to be courageous. Yes, sometimes it's important not to act, but I think hadn't we not acted in these periods, the story would be much worse. And don't forget, I signed a contract, and I'm going to, that again I take personally, but that's an incentive question. It's not my view on the world. This is the contract which I have signed. This bringing prices back to the level, to the objective that we defined in the Governing Council. That you may have a discussion on this if you don't agree the 2003 way that the Governing Council defined the price stability objective. We knew that this process of normalization would be long, and it is true that we face this very difficult thing because, as you mentioned, we come more or less 4 years after the US to reach back the pre-crisis level. Germany, France, it's about the same. It's about the same. Italy is not yet the case. If you're Spain, it is no, more or less no. I mean, end of last year, I think that they reached that level. So a big heterogeneity, of course, which we have to manage with a single monetary policy without states and all that. I'm not sure your Taylor rule will capture, all this and the sort of loops, doom loops that you can get in these situations. No, that was my second. The third point. We have communicated a lot about our expectations. I think you say it's not enough, but we have communicated a lot about, no, I give you more. First, we have communicated a lot about our expectations. Expectation is Delphic, okay, to make it simple. It's an expectation. Expectation is a mean of a distribution. So, okay, an expectation. Or you go intention. My intention is to do something. That's more Odyssean. My intention is to do that. If you go put even more, I will do that. I intend to do that, or it's an expectation. Okay? So it's very important to understand our framework. I usually try to explain, because people say we communicate only to academics or to market people. We try to explain to the people what we do. I mean, when you go in an expectation, one say it will be data conditional. That's a little bit how we saw on average the world progressing. When you have an intention, you say, okay, I'm going to do this because I have a relatively strong view on the circumstances so that what I intend to do, what I will do, is sufficiently robust to new information coming in. So it's not so easy to do. Of course, it's credible, up to a limit, of course. So it is not easy when, for example, to tell you, when we changed in October 2014 and we said that we're going to bring back the balance sheet to the level of 2012, because after the reimbursement of all the banks, massively, money supply, the growth of money supply was falling and credit was falling. We had a very big reduction. So we said we expect our balance sheet, as a result of some of the measures, we expect the balance sheet to go back to 12. 1 month later, we changed the word. We say we intend to bring back the balance sheet. The market reaction was very strong, because they understood the signal. So you're going to really go into that and take a bold direction. So it's not only the whatever it takes that was, usually people say whatever it takes, it's not so easy to communicate, of course. These are all the things we did. It worked pretty well. Now, as I said, history will tell. The end of the story is not yet there. But that's what we did. So we use this communication device. Expectations, we communicate intentions, and the conditions under which our stance would change. And that's called forward guidance, of course, as you mentioned. Now, let's go to the last Governing Council meeting, for example, just as an example. We repeated our steadfast commitment to reach our aim. And, I mean, this is a mantra, because ad nauseam, you repeat your objective. Why did we do that? We did that because some of the Q&A, I don't know if it's Claire or someone else, Mario, you mentioned 1.7 in the projections for inflation. You had a little bit this 175 you had. It was the same problem we had. Did you change your aim from close to 2% to 1.75? Markets start to be nervous. We say, we have to recommunicate what we do always. It's close to 2% in the medium term, and I can explain why the medium term, but we have to reaffirm that. We reaffirmed. And that's, I speak in the name of the Governing Council. I don't speak in my name here. I mean, they would agree with me. Francois is gone. Another example, on the forward at the last Governing Council meeting, the forward guidance framework was reconfirmed. Of course, there is discussion about, looking at the language, and things like this. But the forward guidance was confirmed. And we to make clear, we say, including the sequencing, for those who didn't really understand that. Of course, market react, you are going to revise your communication, your language, what is this? And then you had, of course, as you know, that shows you how delicate these things are. So the framework is confirmed and is supported by them. The question, of course, the discussions, well, say the conversation are more, and I said it, and I think it was also nicely said this morning, more or less by Jens Weidmann, I think. We had a conversation indeed, and I think you rightly also said, are you too prudent or are you too hasty? What are the risks of being too hasty or too prudent? Would you split a group by saying, no, these are the hoax, these are the doves? I'm sorry. I would say it's a good discussion. It's a good conversation. And you had it also in your presentation. What are the factors which are temporary? To what extent is our base scenario at risk, upside or downside risk? I mean, that's what, and that's at the last Governing Council again, and I would say also the previous one. The main discussion goes there because once you have engaged, and that's called path dependency, once you engage in all what I've said before about your policy, your guidance and all this, even those who don't like this, who didn't like this policy or had different views, whatever you call them, would also act responsible to say we have to bring this to a sort of normalization process. We should not forget that. These are responsible people around the table. So, of course, we say it should be time consistent and should be data dependent. So there's a little contradiction between the two. There is no contradiction if you think that your guidance framework has Odyssean, that's more time consistent, you go, and data dependency, which is more Delphic, which we have both in our guidance. And I will explain that to conclude. So in previous presentations that I heard this morning, I don't know when we are, this morning, if policy had been too loose, because it was a little bit hint that it's too loose, including you in your sort of Taylor rules, the mystery of the puzzle of inflation would be even bigger, of course, than today. So I would like to know with that sort of, message or that maybe we have been too loose, why is inflation higher? And then, of course, we have a lot of discussion given all what we have done. But if you would, say that we are hyper loose, why don't we? Then you go with financial stability, but that we can discuss also. But then, it would be bubble or bubble square, something which is difficult to see in Europe. You can say prices may be stretched, but bubble square or cube, I think it's a bit difficult given the sort of excess loose policy that somehow you have alluded to. Just to finish, economic, and then I a little bit go for finish the guidance. Yes, we have economy is going much better, synchronized, broad-based. 2 years ago, we had the G20 communique. Don't forget, we have the emerging market shock. It is true that the world economy goes back to growth. It's synchronized. It is again not a coincidence. Has been a little bit overall policy measure. Even the Fed slowed down, the normalization process when we had the Asian crisis. I mean, the emerging market crisis, and etc. We came also. We had on the U.S. I'm more nervous than the figures you showed. I see a full employment economy. I see a normalization process on rates, which is very prudent, and I see an expansion which we estimate, or staff, this time, following our same sort of calculation. But I fully agree with what it is. It's very difficult to know exactly what it will be. But I prefer to take a more central banking risk sort of avert sort of position. We calculate more or less in delta compared to pre, and not the yesterday agreement. You get something like a delta of 70.75 of GDP and 75 of GDP, 18, 19 of discretionary expansion. Now, I can discuss, I just launched these figures. These are not small figures. Now you can say that people are going to save that money and not spend it, which is very small multiplier, 0.3 usually people. I don't know. I just say I can understand why you can see some nervousness in the market, full employment, fiscal expansion. My point is not to say it's going to be like this or like that in the US. I just want to say that our guidance framework is quite important, as we had in 13, to preserve the conditions which we think are appropriate. People may discuss they are not appropriate, but that's not my point now. My point is to say We want to be confident that if there is a shock there, we can, to some extent, keep the condition. You can never, of course, because the world is so interdependent. But our guidance has protected us very much from the taper tantrum in 13, more than even we thought at that time. Now, so the normalization, communication, very quickly, it's very easy. First, 13, the forward guidance that you mentioned, worked pretty well. There was a taper tantrum. You disconnect the long end from the US bond market. Today, as I see, there is a new risk. So it's very important to stick very firm to our guidance framework. And I think that's understood. That's my first. The second, when we reached the lower bound, or more or less the lower bound, it was near zero, a bit below. The forward guidance on rates, low or lower, that you mentioned, was the stance, of course. Was not to protect against, was really a stance when you hit, more or less the lower bound. Then we had the guidance on the APP, was before the public purchases. And then, as I said before, you go from an expectation of balance sheet to an intention of balance sheet. And once you have the intention, which OD's in, how do you do it? And then, of course, we went into buying government bonds because you would not have found a supply on private bonds on the market. Now, when you think about communication and forward-looking communication, I tell you that if you read what we say, how we communicate, I think there's a lot if you read it carefully, you would see all this. Expectation, intention, how much can you buy, PSVP. So one question that you had in your conclusion, Volker, is when you say no projections, why don't we take our own rate projections, in our forecast? Well, actually, to some extent, we do that. Because when you take market prices, to a large extent, they reflect what we communicate. Now, not perfectly, but a big part of what you communicate is in market prices, which we inject in our projections. Now, what we do with the staff is to say, the market prices, are they deviating much or not from what we think will happen, thanks to QE or these sort of measures. And that we do that exercise. And it is true that if we think there is a big gap because markets really don't reflect what we think should be the consequence of our policy that we pre-announce to some extent, what do? We take measures. We can communicate more. And then we'll say, as a result of our communication, we are back on the baseline, provided that markets would, of course, react to the new measures we take. Wow. It looks complicated, but it's a continuously interactive things. Now you can say we are dominated by the market. So you mentioned that. I don't know who dominates who. It is interactive things. It is true, as you were saying, if you deviate too much from, let's say, some fundamental, you're going to be punished one day. That's clear. The other way is also, the markets should also listen. The market is also responsible. If they say it's quiet, we reduce uncertainty by providing a framework. If they start, saying volatility is going to be like, well, we just want to be sure that the systemic implication will not be too big. What happened the other day, it's fine. I don't care. I think it's fine. Big spike in volatility, fine. I mean, if they wanted to play on this, we know that it was highly leveraged. All this selling, protection against volatility, they've been burned. A few hedge funds have been closed. I think that's fine. But we want to be sure that the financial stability consequence will be contained. I don't say they are or they are not. So far, we don't see. But I think these are things.
Keep some steam for the Q&A.
Yeah, but that's the purpose. It's not to have a Q&A. So my very last point, and if you are interested, I talk about the future. When we had this guidance on rates, which was more Delphic, and then we had the APP, which was more Odyssean, with the intention. We also had an option to go more. And it's asymmetry. I agree with you. It's asymmetry because we saw the world that way. And that can be discussed. I agree with you. That's a discussion. We present it that way. But the thing we did is link the two, as you said. So we say the well past. Now, the more you go we have a number of criteria where we reach inflation. You remember? We have convergence, the path. We have to be confident on the path. First, you have to observe a path. And then you have to be confident on that. And then you also have to ask yourself the question, when you withdraw accommodation, is the path still what you have projected, let's say, in your base scenario? And and we say when you withdraw accommodation, when we call it sustained adjustment of the path of inflation, you stop the APP, the asset. Is it September? Is it later? as you know, we kept optionality. The question is not to say when you go from 30 to 0, and then you calculate, as the consequence. As you rightly say, you have to look at all the implications because your guidance on APP, on rates, are intertwined. And so that's why we are very careful also about, as you rightly said, if you have an end date at some point, you want to be sure how the markets will react, given the fact that this construction is clever, I would say, but not too clever. You have to be careful about this. This, I think, is well understood, and we are careful about if you drop a conditionality or you change a bias. And it is true that in the last Governing Council, or the previous one, when we said in the accounts that we will have a discussion or a conversation about the language, for example, we could also change the language. We said, change the language. We could change the language. It is true that these are the sort of discussions. For example, and I finished, when you reach, sorry, Marc-Olivier, but you also took more than the president usually takes.
I do apologize.
Okay. So when you go, but it's really a very important question. When you get closer to the time, and as I said, we are confident. The Governing Council say we are confident. Also the wage negotiation, we are confident we go to that path. The closer you go to that situation where we'll say, yes, now we are sufficiently confident that we can stop. And I don't want to give a date. First, it's a Governing Council, so I don't want to say anything about the decision which is not yet taken, which is not always the same from some other people, okay? So I don't want to say anything which is not yet decided in an account, but just to explain in what is the mindset to take a decision. Well, the more you get closer to that, it is clear that you will have, and I think that's in your presentation, Volker, it is that you have to be more specific about what do you mean with well past of an interest rate, which is too Delphic in a way. And that's something when we say we are going to discuss. Now we are only, I would say only, we are in March. February, sorry. I say March because I'm preparing the March meeting. So we are in February still. So we have to reflect carefully about this, also because the data come in. Well, you have the fiscal. Brexit has been mentioned here. It's a negative supply shock, that's clear. How big is the negative, as rightly Mark Carnley has been saying, it's a negative supply shock in the UK. How big is it going to be? It remains to be seen. But it is a potential to be a significant shock. It's not so easy. The more you go in this dossier, the more you see the complexity of this dossier, if you look really into the details of that. So I pass on this, and that's a conclusion. So the conclusion is, yes, it's true that we go into this debate, which is a good debate. I'm not rejecting that. Too prudent, the risk of being too hasty, and on the collateral damage or not, etc. I think we have a path. It works according to the plan. And, well, so far, so good, I say. But the story is not finished. I fully agree with you.
Thank you, Peter. I feel guilty for that. We've breached the limit, which shows that central bankers can go beyond the target. But we still have time for a Q&A, and I suggest that we take 2 or 3 of them. So there will be the lady there, then the gentleman with the green hat, and somebody behind on the other.
So I have Michaela Markson from Societe Generale. I have a question for David. When I look at the dot plot, I'm really puzzled. I hear from a lot of people in the US that the US is doing fiscal stimulus at a time of full capacity. And when I look at the dots, normally you would think that something like that ends in tears. When I look at the dots, I can only see one dot that's sort of below that kind of end in tears story and consistent with that in 2020. Of course, the story could be it ends in tears in 2021, which is harder to then see from the dot plot for obvious reasons. But then when I look at this idea that I would get a lot of inflation coming through from this stimulus, there's only a few dots that suggest that as well. Now, when I look at the central dots, it suggests to me that really what we're seeing in the dot plot is that there's more slack in the economy than the headline unemployment rate suggests, which allows this very nice smooth pass upwards. Now, if I'm trying to interpret it in another positive way, and Yellen spoke about this back in 2016, she spoke about demand side economics basically being able to push through on the supply side. She was looking at it the other way around, but that was a theory. But if I'm looking at it from that way, I should have a higher neutral rate, a higher longer run rate, and that's not what I see. So sorry for the slightly long question, but I was wondering, how should I understand the dot plot in tax reform? And if the answer is the tax reform is not yet in the dots, wow, I'm looking forward to March.
Thank you. Let's take the other question, which I'm sure will be short.
Very short. Erik Hene, I'm a private shareholder of the Central Bank of Belgium. And because of this, Peter knows that I started very long. I started warning against the financial crisis many years before it started. Today, once again, I am confronted with everybody ignoring what happened since the crisis broke out. Very clear, the debt which was too high skyrocketed, the interest rates which were too low went to zero, the institutions which messed up were kept afloat, and the people who messed up got promotions. Mr. Pill concluded his presentation with, "This crisis may be behind us, but we are experiencing interesting time." And my question is, really? Thank you.
Okay, and there is another question on the other side.
Yeah, Sascha Butcher.
Can you introduce yourself, please?
Yeah, Sascha Butcher from Deutsche Bundesbank. I have a question for Mr. Altig, because I remember you saying you were sure that Slack has disappeared, and you were talking a bit about that unexplained residual. But considering that that U6, the unemployment rate, which takes into account the persons who are discharged, is still at 8.6% last month, wouldn't you entertain the notion that there still could be slack in the economy, and that's what's not so puzzling is maybe why don't we see the pickup in inflation? But and this maybe goes to Mr. Praet, because I see him nodding. There's an interesting ECB working paper by Michele Lenzer that you might be familiar with from 2016, where he has a horse race of output gap estimations showing that an inflation predicting measure of the output gap that fits the data well would point to a substantially larger output gap and considerable slack that still is in the economy. Thanks.
May I ask the panel to answer and possibly to react not only to questions but points raised here? Do you want to start, Volker?
Okay, I mean, I'm going to react more to just two clarifications. If I understood it correctly, you know, because you referred to these Taylor rates, and if I understood it correctly, what you put up was actually his attempt at estimating the ECB reaction function, right? And so for him, it was good to match the. So he was picking coefficients and throwing in the PMI, and so then for him it was more a signal. Oh, the ECB is changing course from how it behaved in the past. Is that correct? Yeah, and that would mean there could be a good reason for that. But then the question would be, okay, why did you change your own behavior? What I was trying to do was use these 0.5 coefficients, so maybe because it was a good signal before the crisis, what does it signal now? And I think the main point was not that it supported the 2011 raise. It actually, if you look at it, it supported lowering interest rates further in 2008, 2009 to negative. So it would have called for QE in 2008, 2009, but it would not have called for QE in 2015, 16. So that's the point there.
Do you have a 2005-6? Just by curiosity. You don't have.
Well, I don't know if we have time to go back to the slides, but
just because it's linked to the other question of Erik about monetary policy and bubbles. So
in 2005, 2006,
the recommendation in the pre-crisis.
Yeah, pre-crisis it would have been also for the euro area. It would have been higher.
Higher.
Yeah. So there is just like for the U.S., not quite as strong. You know, you had the heterogeneous euro area. You had booms in Spain, Ireland, Germany. Actually, at the time was kind of the sick man of Europe. But still, would have given that signal with the. But I thought the other point was interesting, and I wanted to follow up with a question. You said 2003 definition of an inflation objective, and somebody, my friend Mr. Ziebert, pointed out to me that an interesting report by the ECB in the monthly bulletin a few years ago that one of the reasons which was used in a 2003 midterm review why the target was raised, or the definition was raised, was measurement bias, right? There was a view that there's a measurement bias. The other point was the zero bound.
But the relative price across countries, the relative price.
And more recently, but the ECB has published that they don't see any bias anymore.
Small.
So that would be an argument for maybe it's not so bad.
It's another discussion. I mean, it's another discussion. Should we change the target? That's a long discussion. No, I mean the question on financial stability is a terrible question because we are in an extremely painful process. I mean, there are many dimensions, unfortunately. So, Eric, why was it so bad? I think that we didn't have we had a framework actually on credit, money and credit, the second pillar in the central bank. But it is true, I'm not talking only Spain where credit was booming at more than 25% on yearly basis, just pre-crisis. But even for the euro area as a whole, you had more than 10% nominal growth of credit. So it is true that I'm very often looking back, in the introductory statements of my predecessors, how they would deal with the communication at that time, in the boom time, because I came in 11 in the bust time of the crisis, and just at the time where the economy was plunging after the short recovery of 10-11 when it was falling again in a recession. That's why I say one has to look also as the chain of events that we had. And so it is true that it has been extremely heavy, as you know. Some countries, it's true also, Eric, that as you know, in Belgium, we had, as in a few other countries, massive risk, on the banking sector. It is true sometimes difficult to see, that smaller problems in bankings are difficult to handle because we had a multiple of GDP at risk at that time. So it tells you one thing, is that the importance, I think, certainly in this institution here, is the importance of having good institutions dealing with banking crisis. So for the future, so what we do now is, it's true that we have massive stimulus because we had a huge impairment in the credit. We had also this fragmentation story, which people say, okay, fine, you would have to blow up your before the whatever it takes, you blow up the euro area. It would have created a huge shock. I mean, we are all convinced of that. So you have to see a little bit the legacy of all that, which we went to do. Now, it's very recent, actually, that we bring back this economy, this huge, complex economy, to the path. It's relatively recent, actually. No, it's fair. I mean, the discussion is okay. I mean, you talk about now the normalization. But what we say, we have to be very prudent. Now, are we too prudent and we create new bubbles? Well, we monitor history. We don't see that. We see pockets of bubbles in real estate in some places. I don't know what you think about equity prices. I'm not doing that. But if I read the financial stability review of the vice president is in charge of financial stability. When you see all these benchmarks we have on the stock prices, seem not to be exuberant and certainly very different from what you see in the US. Now, if you look at some markets, if you take the Bund, for example, not taking too much risk when I talk about this, but it is true that if you look at sovereign debt markets in general, you have, of course, very much undershooting of prices because safe asset flights, and then you go back and things like this. So you have all these phenomena there. By the way, when you mention Italy, just to take one example on Italy, how difficult the thing is. You come with your project. I don't know if you know the duration by heart of the public debt in Italy. I don't want to...
It's improved. It's longer now.
Well, how much is it? Because in your...
Yeah.
Well, I know the figure. I don't know if it's public, by the way. So I know the figure. We do the same, of course. We have that sustainability analysis where we have plenty of shock and we have really the figures. The debt is relatively sustainable, is relatively resilient because the duration is quite long. It's quite long. They've done that, I would say, wisely, to lengthen, even paying a bit more, but having a very big lengthening. So the sensitivity to interest rate shock is not that high in Italy, actually. And that's one observation. The other observation is you can rewrite the world from another optic. The problem we have very often is that even in your slides, it's very often as if the monetary union was Germany, the monetary union, in one of the slides, I think. So what we had what we had is we take another perspective. For example, I could say, because you talked about Italy, if Italy would have the same, which is a difficult counterfactual, but the same primary surplus, okay? Suppose whatever happens, they keep the primary surplus. And you just put the interest rate without the sovereign debt crisis. I know it's artificial as all simulation. You get a totally different results in terms of that. So the discussions we have in Europe, that's my point. It's not to redo the past. But when you get rates going in double digit and relatively short-term debt to refinance, even if you keep your primary surplus relatively conservatively, your public finance get out of control, of course. That's what happened, actually, because it took some years, these higher interest rates. So when one talks about financial repressions for the savers in some countries where the rates are zero or even slightly negative, well, financial repressions, many people can argue that financial repression. So what is clear is that the framework, of course, was not solid enough, the institutional frame. So we tried to improve it from the banking side, etc. All these capital requirements, liquidity, and all these discussions that you have in the agreement. We will see what happens in Germany about this difficult question about avoiding sovereign debt crisis or the banking crisis. So I'm quite just wanted to remind you that many have short memories that we are just going out of a traumatic thing. And we are not yet totally out of this. So it's true, there is some bias, I fully agree with you, with the risk linked to a bias, which is more on debt bias, that if you do something, you get it wrong, good luck to start again, to say, I made a mistake, and I go the other way, because your rates are close to zero. So there is indeed some asymmetry, I agree with you, but it's on purpose that we are careful not to just to throw that away and say, oh no, the risks are totally symmetric. We're still there. Okay?
Okay. Dave, you promised to be very short.
I will very quickly respond to the two questions. So I can't obviously explain the dot plots. However, I took some ownership of that path with respect to my own forecast, and to the question of, is the fiscal policy stimulus in there? Not much. I mean, it's still the case that we are not picking up signals yet that would allow us to kind of confidently predict how big this is going to be, or even through what channel. I mean, the initial thinking was it would be an investment boom coming out of the kind of corporate tax changes. Not so clear, though, that we won't need to be looking at sort of the channeling back through increased dividends, buybacks, wages. So even the channels through which we're looking for this to have an effect may be much different than what. So for now, I'll put it in when I see it. To the second question about U6, I think for most of the recovery, U6 was a better measure of slack, but now U6 is below its pre-crisis, at or below its pre-crisis average. The one place to look in labor markets for the possibility that there's slack is in the labor force participation rate. The demographic trend is clearly pushing that thing down, and yet in the US it's flat. That may be symptomatic of some slack. If you look into the details of that, it's not because there are people on the sidelines who are coming in. It's rather that the typical flow out of employment into not in the labor force has slowed down. So what we make of that, we're not quite sure yet, but if we're looking for whether or not slack is bigger than what was in those pictures, that I think is the place to look.
Thank you, Dave. You will have the last word.
Well, I think a number of things that I'll try and be very brief. I mean, I think what Volker said, I just emphasized that I think what we were not trying to have a normative view, but just sort of really say, here's a benchmark. And I think, I would just repeat, but I think in a way Peter is agreeing with me, I hope, that creates two problems. You have to reintegrate the economy into your interest rate process post-crisis. And that is a difficult thing, and I think you're doing it quite well. So I was trying to congratulate you. The second thing is, I still think, and I think what you're saying is, you are erring on the side of keeping rates low beyond the point at which, if you were just dropping from Mars, they would be as low as they are. That's, I think, the bias you're describing. I think that does create a question of how you normalize. Normalization seems to me to have a secular element to it. And I think that raises the question of how much you want that to be very certain versus how much you want it to have some volatility in it. And I agree with you, recent developments are healthy, but the question is, how we continue with that. So this is a slightly odd way of concluding, but it also addressed the question I was asked. I mean, I think in financial markets, things always end badly. And if you're an economist, people say you're dismal because you say things are going to end badly. But in financial markets, things end because they go badly. If they don't go badly, they keep going, right? And I think that dynamic is the one that's very, very difficult to control. I think the only exception to things always ending badly is this panel. So hopefully it ended well.
Thank you very much.